Good morning, everyone. Welcome to this update for global stocks and commodities for the 13th of October. Last week, I talked about not going defensive because I'm increasingly seeing through the media and also questions and comments that I'm getting from various places that a lot of people's mindsets are starting to just get overwhelmed by all the stuff that's out there, and there's been just so much of it, and it never seems to go away. So it's an understandable reaction that you may feel as though pulling back is the appropriate thing to do. But I just want to follow through a little more on that theme because it really is important. I don't know what media that you are consuming, but just be aware that it's probably misleading you. I think that's the point that I want to make, and I think it's the point that you need to acknowledge. If it's getting in your head, all the stuff that's out there, the trade war, the Brexit, Hong Kong, impeachment, recession, what the Fed's going to do next, it's overwhelming. If that gets in your head and you're getting anxious about it, then I can tell you that you're missing opportunities. And the opportunities, particularly in the Australian market, in the small cap and medium cap space, are just extraordinary. So I really strongly urge everybody to just be aware when you're reading stuff in the media that you've just got to put it in perspective. And hopefully this weekly session helps you with that perspective. But the other key thing that I want to touch on today, and I spoke about this over the last couple of weeks, and that's the consolidation that's playing out in gold. So that'll be the major focus of this particular update. Really understanding the key drivers that actually drive the gold price. Portfolio analyst last week, we looked at a number of things, the art of contrarian buying, and that's a mindset that is just so helpful. We also did a review of the gold market, and of course the 10 bagger portfolio, which is just going along brilliantly. So that was last week in Portfolio Analyst. American stocks from the week. They were up 18 points in the end. It was a bit of a roller coaster. Very strong finish to Friday, but it did come off its highs in America. So net, the week gained 0.6%, but Friday was an incredibly frenetic day in terms of information on a number of fronts. What happened on Friday, though, I can only really describe as a sort of a week of Claytons, and that's probably why the US market did come off well off the highs at the end. Because, yes, there's sort of a trade deal, but it's not really. And yes, there's sort of a QE program being started up by the Fed, but it's not really. The trade deal is, let's face it, is just phase one. They've dealt with some of the easy issues. It's not even written up yet. It's just a discussion point, and the hard issues haven't been tackled yet. So there's a lot more to go in that trade dispute yet. When it comes to the QE program, the Fed is going to be increasing their purchases of treasuries by around $60 billion a month. That's really addressing the liquidity issue that came up in September through the repo market, where things got pretty scary there for 24 hours. But it's certainly not a reimposition of the quantitative easing that we saw from 2012-13 through to a couple of years ago. I read from a lot of different sources, and it's clear to me that investors are clearly being distracted by all these events, all the things I mentioned before, Brexit and Hong Kong and impeachment and recessions and so on. The list goes on. But that's not what drives the stock market. The stock market gets driven long-term by earnings growth. That's it. All these other things are noise, they're distractions. And if you look at history, they don't actually change the direction of markets. Now, the US reporting season starts next week, so hopefully that'll get investors refocused back on the thing that matters most, and that's earnings growth. So that will be a pretty pivotal section in the next month or so. And just consider how many times this bull market has been called as over since 2015, 16. It just happens repeatedly, several times a year. Something comes up, and the media seizes on that and says, "Well, that's it. It's all over this time." And of course, it isn't, and it doesn't, and it just keeps marching on. The other key point that I want to make is that bear markets never start when sentiment is as poor as it is now. I mean, sentiment really is dreadful, and credit is abundant. Bear markets start when everybody's euphoric, everyone's pushed their chips into the middle of the table, and credit is being tightened. And credit is being tightened because people are just getting, too bullish. Well, that isn't the case now. Sentiment is terrible. And if we look at the chart that I'm going to show you next, there is just an abundance of easy credit that's out there. And it's pretty hard to fight the facts. You can either go with the media and let the media influence you and tell you that things are terrible, or you can just look at the facts and decide for yourself. The US dollar was down sharply on the week, and the 10-year yield bounced from 1.53 last week up to 1.73. Still very low though. So there's the chart that I was speaking of. This is from the Federal Reserve, and you can see going back to pre-2008. And you can see here that credit starts to tighten. So as this blue line is rising, that means credit is tightening. And you can see that credit tightened significantly leading into the GFC. Backed off a little bit and then really took off as the GFC really took hold. We had another correction in 2011. You can see the credit spread started moving up, so credit was being tightened prior to the market coming off in 2011, and the same in 2016. Look at where we are now. There are no signs that credit spreads are moving higher. In other words, credit is being tightened, and you just don't get bear markets starting under that sort of condition. So before I go to the Aussie market, let's go and take a look at the US market. So this is the S&P, and if we pan back and take a big picture look, you can see that we hit a peak in January of 2018, and really there's been a lot of fluctuation above and below that, but we're only fractionally above. We're only a few percentage points above the level that the S&P was at nearly 19, 20 months ago. So, there was quite a scare in the last quarter of last year, and that was really about the Fed saying that they were on a path of tightening rates. And the market, completely did not accept that at all, said that was going to be terrible, and the Fed had to, of course, reverse direction. And as soon as they did, the market went straight back up again. So that's the big picture on the S&P. If we zone in a little bit, you can see that we've still got the 50-day moving average is still above the 200, so we've still got positive orientation in the moving averages. The price is spending sort of an equal amount of time above and below the 50, but consistently above the 200-day moving average. We had 2 days in May where it fell below it, but other than that, you've got to go back to the scare of last year when the Fed was tightening, and all that has completely changed. And I think probably changed for the foreseeable future unless inflation breaks out. And let's face it, inflation hasn't broken out for the last 6 years when it's been predicted to do so. So, why is now any different? So in the absence of inflation breakout, there's no way the Fed is going to get back onto a tightening cycle. We're going to have low interest rates and quantitative easing for as far as the eye can see. And under those circumstances, markets are probably going to be okay. So, to me, that's the only way to sort of look at the market as it is right now, not what it just might possibly become. Because, that's just a dumb way to look at the market, I believe. And I'll have more to say on that a little bit later in this presentation. Okay, so that's the S&P. If we look at the US dollar, you can see we come off quite sharply on Thursday and Friday. We've still got an overall uptrend, So we're just bouncing around within this channel, but certainly came off towards the end of last week. If we go to the Aussie market, again, we've got the 50-day is in positive orientation with the 200-day, which is still rising. So the Australian market is still in positive mode, and we're just sitting in between the two at the moment. What bothers me about the index, and look, I don't really pay much attention to the index because I don't trade it. It doesn't mean anything to me. So for me, it's of purely academic interest only. But a lot of people seem to follow the media and follow what the index is doing. And as you would be aware, the index is made up heavily of the banks, and there are so many headwinds for the banks at the moment. And again, for as far as the eye can see, that it's really, really difficult to see how bank share prices are going to go up, and therefore, how the heck is the Australian index going to go up? I think the balance of probability is if the market's going to move, it's going to move to the downside. That's my understanding of the facts and my view of the facts. Just while I'm here, let's look at the Aussie dollar. So we're still in obviously significant downtrend. We had a little bit of a bounce last week, but we're still well and truly below the 200-day moving average. So 67.94 is where we finished on the Aussie, and that was really just currency related. Our market put on 44, and we're holding that 200-day, but that's so many long-term factors against the banks that it's just hard to see them being able to move positively. Now, precious metals, the main thing I want to talk about this week. Gold fell quite sharply. So as you recall, over the last few weeks, I've been saying that this is a period through October that is highly likely to be weak for gold for a number of reasons. And that is indeed playing out pretty much as I expected it to do. Gold had a little bit of a positive blip early in the week when markets were in a mild panic mode, but then as soon as some positive news came out of the trade deal, or seemingly positive, then gold was back down under 1,500 pretty quickly. So to me, this correction is just going to continue to play out probably for another 2 to 4 or 5 weeks in the absence of any new money coming into the market, which would be caused by some sort of financial panic. So if Trump takes a stance via Twitter that the market doesn't like, then we'll probably see gold shoot back up again. But in the absence of that, I think this correction will continue to play out, and I think the stronger likelihood is that gold prices will move down from here for a few more weeks. Now, I just want to cover again, because I did get a few questions about what I spoke on last week. There are 3 things that effectively drive the gold price. One is what's happening in the gold futures market, which is driven by speculators. And I explained that last week, the fact that these guys operate on a 4% margin, therefore they're using 25 times leverage, and they cannot afford for the market to go against them for very long at all. So they're very twitchy kind of traders, and they will react to any sort of short-term negative. And the reality is that the futures market got an incredible imbalance leading up to September, where the number of futures contracts to the long side were like 9 or 10 times the number of contracts to the short side, which is a completely unstable position. It means that everybody's sort of, pretty much long. There's not that much more money to come into the long side, and therefore any selling that starts up is going to have a cascade effect because these guys are so highly leveraged. So that's the futures market. And the futures market has only partially addressed that imbalance. The imbalance between the long and the short contracts in the futures market is still way too high. And that's why I believe gold will not and cannot rise until that imbalance gets corrected by some more downside. The second driver is the need for consolidation. The fact that when markets reach a level of overbought, they need to consolidate, they need to pull back, because there's just an imbalance between people who've got their money in the market and those that want to take some profit. So you need periodic consolidation of prior sharp advances. Now, that was helped at the end of last week by the fact that there was a bit of a reduction in fear about trade. So that helped pull gold back down under 1500. And the third driver for gold is any new money coming into the gold market that traditionally isn't there. So in the absence of any new money coming in, and that's money coming out of equities that doesn't tend to play in gold, or it's money coming out of bonds that doesn't tend to play in gold. So in the absence of that, then the futures market and the need for consolidation in the ETF market is going to play out. And so that's where we sit at the moment. So in the absence of any sort of financial panic that will bring new money flows into those two markets of futures and ETFs, then I think gold goes lower from here for a few more weeks yet. But as I said last week, the important thing is the stars are aligning very, very nicely for gold. I think there's a great buying opportunity, medium to longer term, setting up for gold. We've got seasonality kicking in. November and December are seasonally a stronger period for gold because of buying cycles. We've got the earnings growth coming through for gold miners. Now, gold miners' profits will have escalated significantly in the last quarter because the gold price the realized gold price for US gold miners has gone up, for sure and certain. So they'll be reporting good earnings growth. That'll be coming at a time when there's good seasonality, and hopefully, if the gold futures market does correct itself a bit, we'll be in a very nice position with all those stars aligning. So I think great opportunity building for gold, but it's not yet. Precious metals, it's a real roller coaster for GDX, but net it closed down on the week. So let's jump in and take a look at the gold market. Okay, so there's gold on a daily basis. So you can see Friday was quite a volatile day. The peak to trough was 1474 to 1503, which is quite a wide range. We ended up sort of finishing in the middle. So initially gold was down when the stock market was very positive, and then as the stock market came off its highs on Friday, you can see gold rebounded. So there's a very strong link between positive and negative sentiment in the stock market and what's happening to the gold price, and that's going to continue. If we look at the weekly, give us a bigger picture. We had a powerful breakout. We're in a wave 4 consolidation that typically takes longer and goes a bit deeper than the wave 2 consolidations, which we had here in March, April, May. So that's why I think this will roll on for a bit longer yet. And then once that's complete, then I think gold moves higher. If we look at GDX, pulling back to somewhere around the 200-day moving average, I think is a reasonable expectation, because that brings it back to the 200-day moving average, which is a pretty good long-term marker of support in bull markets for GDX. And also the average correction in GDX is around about the 25 to 26 mark. Now, it fluctuates fairly wildly around that level, but as an average, 25% corrections are about average. That, again, brings us back to where this green box is. So I think somewhere between 24 and 25 is a pretty useful target for GDX. But anyway, we'll play the ball as it comes, and we'll wait for confirmation of a turn. But that's the gold market. I think, as I said earlier, a wonderful opportunity brewing in that sector. But we need a bit more time yet, and we certainly need the futures market to wash itself out a little bit more yet. Okay, other commodities, copper rebounded to 261. That's just really about a little bit more positivity and sentiment. Crude oil also up for the same reason, but look, crude is proving to be a very difficult sector to negotiate. So unless you've got some particular stocks that you like that have got growing earnings for a very specific reason, I just don't think it's attractive to buy energy majors. To buy an Exxon Mobil in America, or to buy a Santos or a Woodside in Australia. I just think there's so many geopolitical issues. There are so many other long-term drivers that are very, very difficult to understand, that I just think it's going to be a very hard sector. There's the spot copper chart. You can see we did lift a little bit towards the end of the week. And there's the 1 year copper inventory levels. So as inventories rise, copper is going to be under pressure. And obviously the reverse applies when inventory levels get drawn down, then the copper price will rise. So you can see we've been rising pretty much since February. So that's kept the lid on copper. So for anyone that likes to trade in base metals mining stocks in Australia, then just be aware that you certainly don't have a following breeze at the moment. Now, nickel is different because of the decision by Indonesia to ban exports of unprocessed nickel ore. They're the largest, or they were the largest exporter in the world. So that's helped light a fire under nickel, and also helps us support it. So if you're looking for base metals exposure in Australia, then certainly focus on nickel stocks more than anything else. Final thoughts for this week, and it really gets back to what I spoke about last week and at the start of this video, and that is that yes, things could get worse. This is what the media is trying to get you to buy into, and it's what our psychology would naturally where our psychology would naturally have us leaning, that things could get worse. But, what if they don't? We've had this movie playing now for the last 4 or 5 years, that things were all about to end and fall over and go into reverse. And they haven't. And year after year, the market keeps going up. The people that have stayed in the market have made money and didn't have to agonize about what would go wrong. So the key question that I pose for all investors is, are you a glass half full or a glass half empty kind of person? And it's a really, it's a serious question, because I just know the the one which is the better way to go from an investor point of view, and just the way to live. Do you want to live your life worried about what the market's going to do, or do you just want to assume that things are going to be positive until proven otherwise? And I certainly choose to be the former. Portfolio analyst this week. I just can't recall a more exciting time in the Australian market. We have got some magnificent world-class technologies being developed in this country. Now, we still don't do a great job of keeping them here, but we've got some terrific small cap and emerging mid cap stocks that have just got wonderful global technologies that they're profiting from. And these aren't, some of these are not profitable companies, and they're therefore a little bit speculative, but some of them are well established, and they've got massive order books that are going to sustain them for a couple of years to come. And, we've done wonderfully well out of them, and certainly those are the sort of stocks that are in the 10-bagger portfolio in Portfolio Analyst. So I'm very, very excited about opportunities in Australia. And that's why it's so important not to get caught going defensive, getting into that cycle of, worrying about what's going to happen next, because there's just too many good opportunities out there. There's my contact details for anyone who's not a member, and I'll look forward to being back with you next weekend. Cheers.